In 2014, a financial firm decided to study a strange pattern. They went through years of account data and found something shocking. The investors who made the highest returns weren't hedge fund managers or day traders or people with fancy MBAs. The best investors were dead. The second best? People who had quite literally forgotten they had an investment account. Some hadn't logged in for years. They didn't trade. They didn't buy the dip. They didn't even read the news, and yet these dumb investors were beating the smart ones every single time. Most people believe winning in the stock market requires intelligence, a sharp mind, fast reactions, insider knowledge. But here's the problem. The more active most investors get, the worse their results become. This isn't just an opinion, it's data. The story about dead investors isn't just an urban legend passed around in finance circles. It's grounded in real patterns that keep showing up again and again. Between 1991 and 2020, research from Morningstar revealed that the average U.S. equity mutual fund returned about 10% annually. But the average investor? They only made around 6%. That 4% gap wasn't due to bad luck. It was due to behavior. People bought high when markets felt good and sold low when fear took over. Another study from Dalbar Inc. spanning 30 years found nearly identical results. Investors consistently underperformed the very funds they invested in, not because the funds were bad, but because they couldn't stay still. The data is brutally clear. The dumb money, the forgotten accounts, the inactive investors often outperform not by doing more, but by doing less. One of the most legendary fund managers of all time, Peter Lynch, ran the Fidelity Magellan Fund from 1977 to 1990. Under his leadership, the fund averaged an annual return of 29%, one of the best performances in history. But here's the twist. Most of his investors didn't get those returns. Why? Because they jumped in when the market was up and bailed when things got scary. Lynch later said in interviews that the people who made the most money from his fund were either dead or forgot they owned it. The fund was great, but investor behavior destroyed their own gains. Let's talk about something shocking. Over a 15-year period, 90% of actively managed funds failed to beat the market. That's data from S&P Dow Jones indices, the same people who track the S&P 500. Think about that. Billions of dollars, elite degrees, armies of analysts, cutting-edge technology, and yet the market still wins. Meanwhile, the person who simply bought a low-cost index fund and forgot about it often outperformed the smart money. Imagine two people, Emma and Jack. Emma buys a simple index fund and checks it every week. She reacts to market news. She moves her money around when things get rough. She tries to optimize. Jack invests the same amount, then forgets the account exists. 20 years later, Jack has more money. Why? Because Emma spent years making emotional decisions. Jack did nothing, and that nothing allowed compounding to work uninterrupted. Consider Ronald Redd, a gas station janitor and part-time mechanic from Vermont. When he died at 92, his neighbors were stunned. He left behind an $8 million fortune. He didn't have a fancy job. He didn't trade daily. He didn't beat the market. He just quietly bought dividend-paying blue-chip stocks and never touched them. He lived frugally, reinvested his dividends, and let compounding work for decades. His story is a living example of how doing nothing can create extraordinary results. Compounding is simple, but ruthless. If you invest $10,000 and earn 8% annually, in 30 years it becomes over $100,000. But only if you leave it alone. Even small interruptions, pulling money out during a panic, missing the best days in the market, can destroy decades of growth. According to JP Morgan Asset Management, if you miss just the 10 best days in the market over 20 years, your total return can drop by more than 50%. And here's the twist. Those best days often come right after the worst ones, which means the people who panic sell during crashes are often locking in their losses, while the dumb investors, the ones who don't even notice, are reaping the rewards. A report by JP Morgan analyzed market returns from 2003 to 2023. Stay fully invested, around 9.7% annual return. Miss 10 best days drops to approximately 5%. Miss 20 best, down to 2%. Miss 30 best, practically zero. And 6 of those best days came within just 2 weeks of the worst ones. The dumb investors didn't panic. They stayed, and they won. Humans are emotional creatures, and the stock market is a psychological war zone. Fear, greed, FOMO. These emotions make even the smartest people make dumb decisions. But the dumbest investors, they don't feel those emotions because they're not even paying attention. They don't get spooked by the headlines. They don't obsess over short-term drops. They don't try to beat the market. They just let time do the heavy lifting. In behavioral finance, this is called the illusion of control, the belief that we can predict or control complex outcomes. As Nobel laureate Daniel Kahneman once said, "Confidence is not a measure of accuracy." The most successful investors in history aren't always the loudest or smartest. Many of them are teachers, factory workers, office employees, people who quietly invested a bit every month and never stopped. They didn't need complex strategies or insider knowledge. They just needed discipline and time. Warren Buffett didn't build his empire through lucky timing. He built it through patience and consistency. As he famously wrote in his 1988 shareholder letter, "When we own portions of outstanding businesses, our favorite holding period is forever." This isn't just true in the US. The same pattern plays out across the world. In almost every developed market, the average passive investor, someone who simply buys broad market funds and holds, beats the majority of active traders over the long run. Now, this doesn't mean being informed is bad, or that you should never look at your investments, or that you should just throw money blindly into anything. It means understanding a fundamental truth. Discipline beats intelligence in the long run. The goal isn't to be dumb. The goal is to not overcomplicate something that works best when left alone. You don't have to be a genius to build wealth, but you do have to get out of your own way. So, what can we actually learn from the dumbest investors? 1. Stay the course. Don't let emotions make your decisions. 2. Let compounding work. Interruptions kill growth. 3. Avoid noise. News headlines are designed to trigger fear and FOMO. 4. Automate what you can. Automatic investing removes temptation. 5. Patience beats intelligence every single time.